A couple of weeks ago, I did a video on BCE telling you that there was a big problem with this telco. But you know what? Telus isn't not doing any better. And actually today we're going to answer the question, is Telus worse than Bell at this point? Dividend Growth investors, bonjour, my name is Mike Roux and I'm the founder of Dividend Stocks Rock and I'm also a passionate investor. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And it's quite tough to enjoy your retirement when your stocks are down 15-20%, right? So 2 weeks ago, we did a review of Bell with their payout ratio and which metrics to look at going forward. So I had a lot of questions about Telus and I thought, you know what? I do own Telus, I don't even own Bell, so let's take a deep dive into Telus, and as you can see, it's not doing any better. Obviously, this graph is a bit counterintuitive, like it is just to show you what most investors remember. The stock is down more than 20%. Why? Because they look at their all-time high. So keep in mind, stocks are going up, stocks are going down, and it's not because a stock just hit a all-time high and then it goes down from there that your investment sucks. I do have Telus in my portfolio for several years, and it is still performing well, and it is still paying me a good dividend, and it's quite positive. However, it's true that over the past 18 months, it has been a rocky road. So let's take a look at the Dividend Triangle to see what exactly happened over the past 2 years. So as you can see here, we can clearly see the stock price decline, but what is interesting is the revenue keeps increasing quarter after quarter. That is like showing a lot of stability. So is the dividend, and Telus has this great tradition, I would say, to increase their dividend twice a year. So it gives you a better feel of what's going on with the business, because every 6 months the management will tell you if they're still feeling confident about the business, which so far is happening, so it's all good. They just recently announced another increase for their dividend. So now for 2023, the total dividend increase was more than 7%, still in line with their dividend growth policy through 2025. The big problem here, obviously, is the earnings. As you can see, it went up, it went down, it went up, and it went down. And here's the problem where you're gonna say, well, the payout ratio, Mike, are completely out of control. So let's dig into that right away. So when you see problems when in the dividend triangle, when you see fluctuation either going up or going down where it's like not following the trend, the best thing you could do is to go back into the annual reports and the quarterly reports to find answers to your questions. So I've pulled out the latest quarterly report that was published in November, and Telus explains that they had a lot of things affecting their earnings per share. First, higher cost of restructuring because they are laying off people, they are minimizing their costs, but obviously whenever they make those announcements, bonuses and packages has to be paid, and this is like it is a one-time charge. So yes, it hurts earnings today. This is money going out of their pocket as well, but it's a one-time deal. So going forward, it will actually be beneficial for the company. The second point is higher cost of amortization. So this one, not really a problem. It just helps to pay less taxes. But when you're making major investment into your projects, when you're making acquisition, you're allowed to deduct some amortization. So it's not cash going out of your account. So this one is good. Then we have some impairment as well. So we say, oh, we look at our balance sheet and yeah, some of those values are not right. So we're gonna write off some value of our assets. So obviously that's not good news. I mean, it's not money going out of their pocket, but it's not good news in the sense where they're telling you, well, we thought it was worth this amount of million, but now it's a little bit less. So definitely not good news overall, telling you that assets are not as valuable as they thought they were. The fourth one is higher cost of financing. So interest rates are higher. They are still in a mode where they get more debt almost every quarter to finance their project. We're going to see that later on in this video. But obviously this starting to become a problem as interest charges increases every quarter as well. Finally, they have also issued more shares to finance their projects. So once again, we can see that Telus is in a place where they invest massively in their future, but in the meantime, it hurts their short-term report. So now there's one thing that makes Telus a bit different than Bell, and it's the way the company decided to diversify its business. So both companies are making most of their money with wireless and wireline services, as you can see in this graph, but Telus in this chart, but Telus also has Telus Agriculture and Telus Healthcare Services, which are about 10% of their business. They also have Telus International that is not shown there because they report it separately. They own stake in Telus International, but they spin it off last year, if I remember correctly, in 22 or maybe 21. Anyways, they spun it off, but they remain having like a big investment into that company. And that is also another reason why the stock is lagging. Overall, I like the long-term outlook of those diversification, but it's all about using technology to service specific businesses. So we're talking about the healthcare industry, the agriculture industry, and more investment towards artificial intelligence with Telus International. The problem with that is we are in a down cycle in terms of investment for many companies. We look at interest rates, we look at the economy, we're not too sure what's gonna happen. So a lot of companies decide to build their war chest and invest a little bit less in their technology improvements, which has a direct impact on Telus International, where they also reported very bad earnings throughout the years. That affected Telus. And the main problem was, it's not that the business is not doing bad, but their major clients are slowing down their expenses right now. So they may catch up later on, but at this stage, we're in a down cycle. So it's bad for the business, it's bad for revenues, it's bad for earnings, and this affects Telus in general. So on top of facing higher interest charges, a global economy slowdown, their diversification is not doing that well. As for Bell, the media is a little bit more stable, while as the opposite, over the long run, the outlook, I'm not too convinced about what's going to happen with media, with all those people cutting down the cables to go into the streaming platforms. Is Bell going to be able to generate as much money from a split streaming platform than they used to do with cable? That is also that's basically for both companies at 15-20% of their revenue. Now it's a bit unsure. It could be a growth vector, but it could make them suffer a little bit more going forward. Now, when you look at the dividend profile of Telus, you can see a company that seems quite healthy in terms of dividend growth. So the past 5 years, 6.6 annualized growth rate, past 3 years, 6.4, and then the last year, 7.4. So everything is pretty strong, very juicy yield at 6.2 as well. But where's the problem? Well, payout ratio and cash payout ratio are out of control. So we have to dig into that as well. So it's one thing to look at the metrics, and I use the dividend stock card for Telus. So I see the graphs, I see the numbers, but then those numbers are telling me, Mike, you have to dig deeper. And the only place where you're going to find the answers to your questions at this point is to go back into annual statements and quarterly reports. Unfortunately, there's no shortcut. Well, I mean, there is one, because at DSR we do that for you and we actually explain those into the stock cards. But for the purpose today, I'm going to show you how to do it for free. So then you open some financial statements and you start digging. So my first stop was to go into the 2022 annual report, mostly because I get a full picture of a year. I get more comments from management, and I get a chance to get a little bit more feeling of like what they intend to do going forward. So in their 22 report, management said that they extended their dividend growth policy of increasing their dividend by 7 to 10% in 23, 24, and 25, which is definitely positive, but again, it doesn't make much sense, right? Because now management's telling me, yeah, don't worry, we're gonna keep growing high single digit the dividend, but the payout ratio doesn't make any sense. So again, need to do a little bit more digging. Going forward, we have in the 22 annual report, similar to Bell actually, their guideline for the payout ratio. And they're like, yeah, we would like to pay between 60 to 75% of our free cash flow year after year. But then they say, similar to Bell. So you can see that there's like a similar narrative here. They're like facing the same challenges, they have the same numbers. And then December 31st, 2022, cash payout ratio was at 95%, which doesn't make any sense. But then again, they're explaining exactly same way Bell did. Well, it's because we invest a lot in our infrastructure. So CapEx is way out of line at this point, but it's normal, don't worry. Now, should we worry or not? That is something that we have to answer today in this video. So to understand a little bit better the relation between CapEx, free cash flow from operation, and the dividend payment, I put everything in there so you can see that over the past 12 months, the company paid for almost $1.3 billion in dividend, but they generated a free cash flow of nearly $1 billion. So obviously there's like $300 million here that we do not have, and guess what? We're gonna find it among more debts. Cash flow from operation goes up, goes down. As you can see in 23, that hasn't been a good year for cash from operation. It has definitely slowed down from what they generated in 21 and 22. So that explains why the payout ratio right now is above 100% and outside of Telus target. So on this chart from the annual report, you can see that the payout ratio went from 67, which was like making sense in 2020, all the way up to 140 in 2021, a little bit better at 95 in 2022, but we're still not exactly in line with what we would like to see, between 60 and 75. That's definitely a problem, and as you can see, we do have more money coming up from financing. So 1.2 billion in 2019, 1.9, 950 million, and then 850 million in 22. So every year the company is spending more money into their capital expenditure, so into their projects, because they had to expand their fiber, they have to expand cable, they have to expand their 5G technology, and they have also to maintain their network. So it is a capital intensive business, and we can see a similar trend that we saw with Bell, where the company is forced to get into more debt every year, thinking they're going to generate more money in the future. So for the past 5 years, what you can see here is CapEx has actually continued to increase, and even like was even more important in 21 and 22. Telus saw an opportunity over there, and unfortunately now interest rates are going up, so that will weigh on their balance sheet and their ability to pay a dividend going forward. Speaking of that, if there's a good news here is for most years right now, you can see that it's well diversified, and we do not have that much money come up to renewal in the next 3 years. When you think about what's going on with the interest rates, chances are we're going to start talking about slowing down interest rates, so decreasing it a little bit later on in 24 and 25. So hopefully when like big chunk of money in 26, 27, 28 will come up for a renewal, we're gonna have like medium interest rate, because right now we could say that we're like in the higher part, and then we used to be in a low segment. But if they can renew like when interest rates are down by like 1%, it's going to be a little bit even better. But so far what I like to see here is really the wide diversification in terms of the maturity. So they do not have like a big payment coming up, so that will help them to breathe a little bit more. So now we have a pretty good idea of the situation, where it's the same story as Bell, where we need to look at cash flow from operation, CapEx, and free cash flow, and hopefully we'll see more cash flow from operation, lower CapEx, and bigger free cash flow to cover the dividend. In the comments from the Bell video, an investor said, yeah, but Mike, you didn't talk about like the latest quarter, so what's going on here? Do you have like a different aspect, a different point of view now that we are down 3 quarters later in 23? So I decided to pull out the Q3 report just to see what's going on here, and what I saw at Telus for the latest quarter is quite positive, because we see a decrease for capital expenditure, so from 925 million down to 769. So this is one thing that we would like to see a little bit more. Small improvement for cash flow from operation. I mean, 0.5%, it's not that much. We would like to see a little bit more, but at least it had a positive impact on the free cash flow at 7.3% up. So this is the type of relation we want to see. So it's 1 quarter towards the right direction. It's not perfect, but it's still pretty good. We also see that total operating expense are up 16%, which is not necessarily great, but we have explained what happened on the what affected earnings per share. So that is being reflected in the operating expenses for some of it. So that also explains what's going on with Telus. So at this point, I would say we are moving towards, I kind of like the fact that management decided to maintain their dividend growth rate policy this year and matching that 7% increase for the year. That shows great confidence they will be able to reverse and go back into a healthier mode where they generate enough cash flow to finance their project and also pay the dividend instead of always having to grab like a $500 billion. That's, I mean, today it doesn't sound to be that big of a number, but I mean, when you're piling it up, it's a bit too much. In the end, for the target for the end of 2023, there's like 1 quarter missing. What I like to see here is the capex is a lot lower than what we saw over the past 2 years. So we're down to 2.6 billion for 23, and that will obviously generate more free cash flow at 1.5. That's some good news. The bad news was at the beginning of the year, they expected to generate 2 billions in free cash flow. Now they're down to 1.5. As I told you, there were like a lot of things that affected this number. The first one, the underperformance from Telus International. The second one is the restructuring cost that was not necessarily in the books at the beginning of 2023. So those affected free cash flow going forward. But what I like here is what I can see is if they generate 1.5 billion in free cash flow and they paid 1.3 billion in dividend, we're still in line. I mean, the free cash flow payout ratio would still be quite high, but will be under 100%. So again, one step in the good direction, but not done yet. You will have to be patient. You will have to monitor this company quarter after quarter, looking at those numbers, making sure that it's like one step after one step after one step. And eventually, if they can convince the market, hey, we are generating a lot more cash flow, because this is supposed to be the narrative here. Now we need to see the numbers. But if they show up with the numbers, the stock price will likely go up because the market will give them a little bit more love. Again, we have to wait until we see that. But in the meantime, go in the comment, let me know what you think about Telus. Do you think that Telus is better than Bell? I personally prefer Telus because of their diversification for the growth vectors. Right now, it's definitely not working. But again, this is where you make the difference between the narrative and the numbers. I hope that we're going to see a little bit more improvement in 24 and that my investment will go up, obviously. So see you in the comment. And next Thursday, we're going to talk about another industry that is suffering. We're going to talk about renewable energy stock. And until then, stay invested.